Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer, where you get unlimited trading as well as everything we offer in our web tools for just $99 a month. Without further ado, what we're going to do is we're going to step out and dive right into the portfolio. Today was a pretty big day for us because we placed an earnings trade on AMD yesterday, and this was a calendar strangle trade. And at the time when we placed it, we sort of took a little bit of a gamble with the expectation that the move could end up being plus or minus the implied volatility. We were using the plus or minus one volatility movement as our basis. I definitely encourage you to go back and check out yesterday's video, which is from the 29th, where I talked about the methodology we were using to find the trade and then what we're using to price it out and the implied move and all that stuff. Long story short, we targeted 2250 as today's move, where we would expect it to be. And I think we did pretty good with that. I think the tools did a great job pulling out the implied volatility, understanding the distribution, and getting us to a position where we were able to build a trade that so far is looking pretty good. It's not quite a double yet, but it's a return you can't deny at this point. Now, we will get into the rest of the portfolio later on. As you can see, everything we were involved in is up today, which is kind of it's good and bad. We'll get into that later. But right now I want to talk a bit about the book we're holding for AMD because we've got some decisions to make. Now, this was a calendar strangle. So we had basically the position we have here is offsetting. Let's see if we can actually switch it this way, or what's the best way? Here we go. So we had a calendar spread for calls and a calendar spread for puts, and these were set at the same strike. So what we were trying to do is we were trying to isolate the volatility crush, and we knew that based on our earnings richness and our IV crush rate and all that stuff, we knew that the weekly options for this Friday were expected to see a significant time value decline relative to next week's options, which we were using to hedge against. So we were selling the short-term volatility and buying the longer-term volatility as a hedge. We knew we were going to lose value in these longer dated options, but we wanted to keep their deltas and gammas as close as possible, so that we would be really trying to isolate that change in volatility. And as a result, we got this kind of like this W chart, right? It was up here, and then if we went all the way down here, you'd see it go up again further out as we got to like 16 and a half. Now, in this particular case, the situation we've got is, you'll notice that we're just looking at this thing. It looks more like a butterfly or a single calendar spread, because that's all we're really seeing here. You'll notice that the put side is gotten a zero. And sometimes we could ask questions like, well, why don't we include the put side on a trade like this? And the reason for that, when you're in the book manager, is that we're using the implied volatility for the date you are looking at. And we do a lot of work to figure out what the implied volatilities are. In the event that it lands on an expiration date, it's easy because we can use at the money options. But we do a bunch of other work in the middle of there to try to zero in on, if you picked a date that was arbitrarily in the middle of the week later on, how we calculate that to try to be as accurate as possible with all the option data we have. So then we create this implied distribution, which is just the statistical math that talks about this would be a -1 volatility movement, this would be a +1 volatility, because an implied volatility is just a standard deviation on the expected returns. So as a result, you don't see the put side of it. And we've been asked a couple of times, like, why don't we have scaling tools, like have the ability to scale all the way out to show it, like even though it's virtually impossible to happen over here, like to just include that in the chart. And part of the reason we don't do that is because it makes it very easy for you to make bad decisions. It makes it very easy to justify trades. For example, there may be people right now sitting out there holding this put spread, and if we could give them a way to show it making a huge gain, they might hold out hope that it's going to happen. And so we don't stop you from modeling that. I mean, you can obviously think about it yourself, look at these worthless options and think about all the value that could be if we saw this, a 40% drop in the next 8 days. But seeing as how it's unlikely, we focus more on just where things are right now. Because as always, when you're in the book manager, we always talk about your positions and not caring how you got here. right? We don't care what your cost basis was for any of your trades. It's just, what do you have now and what do you have moving forward? So what kind of changes do you want to make? What kind of moves do you want to make? So that being said, we stand here at a pretty great position, right? We had hoped to make some money, and we would have made some money, anywhere around here. But we're like we just pinned the tail on the donkey here, because this is like right at the money, and for our peak gain. So what that means is that you'll see this number here that says about 2,200. That $2,200 is saying that based on the current holdings of the positions using market pricing, that the modeling shows that if the stock were to close on the first at that point, and we didn't buy to close the options, we just effectively let them expire, or we cash settled them, but just for the absolute intrinsic value and a minor liquidity cost, we should expect to see this much increased value. Now, what that really means is, if you look at that $2,200, you take a position in the book we're holding now, we would be collecting about $2,550 plus $50, so that would be about $2,600 in gain, which means that we'd only be looking to see about $350 drop in the value of the long calls we're holding, and we'd assume these would stay worthless. So at this point, the first thing you want to think about was, we made a trade for the implied volatility expecting a drop. I mean, it was probably in the hundreds yesterday for this week, and it was probably around 80 for next week. At this point, you can see this week's volatility is now in the high 50s, and the longest term volatility is in the above 55. So I don't think we're going to see any real change in the volatilities at this point for these guys. So as far as we're concerned, we got everything we could get out of the volatility crush. So now it's really just a question of, are we going to play a range bound strategy? So if we return to our book, what I mean by that is to say, we don't expect to see anything else get squeezed out from volatility. We're up about $700 on our $1,000 trade, so that's a good 70% gain, which is nice. And now we have to decide, do we want to hold out hope that it stays in here where we can increase the value even more, or do we want to just cash out and take what we have? And then, of course, there is the other option of doing some rolling or adding in positions to sort of hedge out here, because obviously holding onto this here, we might want to flatten this out in some way, like turn this into a condor or turn it into something else. From my perspective, I think we should possibly wait another day or take the money today. We placed a trade, we had a thesis, the thesis worked out, the money's here and it's available. Even if we closed it with market pricing, we're still going to clear about 70% on the current trade. If we legged out, we might even get up to 80%. So that's kind of the view I have. If we go back into the portfolio, we can see that we're looking at 750 with the market pricing. And again, when I say close out, I mean just the call side. We're going to leave it. It's not worth trying to close out. We'd have to pay to close out the this week's 16.5, and we probably wouldn't get paid for next week's 16.5. Now, leaving those open does open us up to some liability, because there is the possibility, at this case, this is a 0% likelihood statistically. Obviously, it could always happen, but just using implied volatility as a measure. From this side, we've got almost a 1 in 200 chance of next week's 16.5 being worth something in the money. With all that in there, what we can say is, let's just take a look. If we were to close the book out, what we'll do is we'll ignore those puts. We'll cut those from our trade ticket. And at this point, we could see it's 38 to 36. If we could get 38 cents right now, or 37, yesterday we legged in, and when we legged in, I believe the net we ended up getting was 21 cents for a debit to get into the position. That was a trade that we opened up offline. We didn't need to stream all that. It was a messy process. But right now, if we can get out 37 cents, then we'd see whatever that 16 cents over 21 would give us as a return. I'm not entirely sure. So originally, when I was following the market earlier today, I was looking at the daily chart, and just to kind of zero in on where things were, we'll kind of cut out everything before market open today. I was watching this most of the day, and you'll notice that even though this looks like it's a big down and up on the minutes, It is, the low here was above, even the lowest price we had here was still in that pretty high range. Sorry, the low for this was as we got into kind of settling in for the day. We were above 22, and for the longest time we stayed above 22.50. And if we were in there, I'd like that because I feel better about being in that position. Now, one of the things I don't want to get into is where we take our, assuming we're just looking at this as a call calendar spread now. One of the risks a lot of people will do is they'll say, well, I see that the stock obviously surged up today after earnings, 17%, almost 18. And what I can do is you can now buy back this call you're short. And if you buy back the call you're short, then you can let the long call run. But you also run the risk of buying back the call that we're short for what would be a pretty substantial loss on that call, and then having the stock drop and us losing the value on the long call. And if we sold the long call later on after losing value, we'd end up negative on the trade. So I view this as kind of a lockstep thing. I didn't anticipate to see kind of a bid catching on later in the day. And so at this point with where we stand, I think we'll see what we can close out. We'll just say we're going to close these positions, those calls, send them to a trade ticket, and see if we can't get a little bit lucky with catching something better here. For if we could get up to yeah, if we can get 38 cents, I mean, it's a little bit more than we're asking. Now, part of the problem we face here is we're unlikely to get 38 cents or this. We're probably unlikely to get the midpoint. And we could even have a challenge, frankly, getting the market price for this trade. And the reason we could have a challenge getting the market price is because this is a complex order, because it's going to go to the complex order book being multi-leg. And that 36 that we see on the market, there might not be anybody who's willing to do both sides of the trade. And again, in this case, we have to find either one person willing to do both sides or someone who can see an edge in breaking it apart and filling the order through different exchanges, or some market maker who sees an opportunity to break apart your trade from the book. Again, unlikely that I think we're going to fill that, but we'll let that sit for a little bit. Now, getting back to the portfolio, this is another thing that we want to kind of check in on. I mean, Carnival, a champ, way in the money at this point. We're looking at just $54 in time value plus the liquidity cost here. So we could see $75 added on to our position if we just kind of wait it out. It could see a drop. I mean, if it gets down to 55 again, we're in a position where we might have to worry about closing it out. But for now, I don't feel like rolling it up. I think we're just going to kind of sit tight and wait it out, just to get a little bit more return on it, see where it goes. I think potentially if it came down as we got closer to expiration, we might roll it up, just because rolling it up here could be locking in the gains we got, but it could be exposing us to a bigger loss at a further expiration or at a higher strike. So we'll leave that as is. Micron, again, we want to see this go down. We've written off the Micron and NVIDIA trades at this point, so we've sort of assumed that we're going to achieve full loss on these. We're already priced in for it, so we'll effectively leave those. We do have the option to come in and take a trade like Micron and go to, for example, if we manage the book. Now, we could flip our view. Now, this money down here is still possible, but it's super unlikely. And what we could do is we could say, well, right now we are short these calls and long these calls, which is a bearish position. We could flip it into a bullish position. Like if we thought there was no possibility of this ever coming back, I mean, we could take this the position we're short here. We could roll it up. We're on the 15th. We can go to, from 33.5, we could go to, let's say, 37.5. And if we roll that, I mean, it changes pretty substantially the view we have. Now, we're able to make some money if it doesn't drop. But if we kind of get snake bitten and it does drop, which it could very well do, we're at the point where we would be down $2,000, because we'd be opening ourselves up to a bunch of additional margin we'd have to put in place. I mean, we would now have a pending cash change, and the margin will actually go up because I'm sorry, not a margin. We're going to pay a bunch of money because we will now be in a debit position where we would have this, and we would be covering with that 37.5. And again, what we'd be doing, the effect we'd have right now is we'd be locking in our losses on this short call and placing our bets that we're going to retain the value we've gained on the long call. And sometimes you get whipsawing. A lot of people like to look at the momentum and say, well, since we got into this position, within the past 2 weeks, or I think it might have been early last week, Micron has done nothing but go up. I mean, it's just taken off and continue to move upward, and maybe it will never come back down again. But I'm not a believer in making those kind of directional bets. We haven't had a lot of luck on directional trading this month, um, so yeah, I'm a little disappointed in the returns. The Nvidia one was what really broke my back. When we were at 160 and then dropped to 135 on Monday, that's pretty terrible for us. And then so the last thing to talk about is our Exxon trade. Exxon, this one has really turned against us this week. We are looking for it to be as low as possible, or potentially for it to move up more substantially, because our bearish trade here, the bearish spread, um, it's now losing money, and it would be ideal to close it out. But every day when we've tried to go in and close it out, we haven't been able to get pricing that we would have liked. Of course, I regret not closing it a couple days ago, and we could have eked out a small gain. But what really got us here was that when the earnings announcement came out, or the earnings date announcement came out, it was pulled in, so it was within the expiration that we've got here. So we're not going to see a volatility drop on that spread either, and we are looking at the volatility rise here. So this 71.5 straddle we have, it has benefited from a rise in volatility, which is why, even though it hasn't really moved much from that strike, we haven't lost as much money as we could. We're probably within, I would say, within 20% of what we paid for that, and we've been holding the position for almost a week now. So all that set aside, let's go check out what we might see for one-day trades again. At this point, this is our one-day thing where we just want to see today's the last day we can trade before earnings, good liquidity, and weekly options. We've got the earnings crush rate. We're looking for a rise here. Facebook, potentially. I mean, we want to see. So this decline's pretty good. That 96% to 58% tells us that the richness is about 15%. I don't know. I really don't know what to expect from Facebook. It's just one of those stocks where there's pretty strong polarized opinions. It could jump either direction tomorrow. I don't feel great about trading it with a straddle, and I don't know that we would necessarily gain too much value. Although that earnings crush is what we're trading here. We're not trading directionally, but we can get burned directionally. So since this is at a richness of 15 percentage points, let's see what U.S. Steel's at. It's 18. That's a little better, but I don't like that the dividend is before then. That messes up our alignment of the calendar straddle. And then Tesla is at 19. So basically 19 percentage points. This is the trade we want to make here, I think. The long-term volatility is around in the low 60s, so we'll expect that this will drop. The volatility on next week's will drop about 50%, but more likely, the more interesting one is this one here. I mean, if it's at in the low 60s, we're going to see this drop 50%. So this will drop about a third. This will drop about half. So let's take a look at what we've got for tomorrow. The one thing I worry about is this is a $300 stock, so it might be a little more expensive for us to get into trade than we want to. The 306, let's take a look at the... in this case, what we'll do is let's take a look at the implied volatility for this, or the implied distribution. So if we come to search results, this will run a quick trade search for us. The implied... So we're looking at a move, so 246 and 335. That's a pretty big move. I guess the implied volatility is pretty substantial. I don't know. Honestly, I don't know the best way to approach this, whether it's a straddle or a strangle. But let's take a look at a short straddle here, and we'll just grab this with one thing and throw it in the book. If you're curious about the details of what we're doing here, please check out any of the videos we've had over the past over the past couple of trades. Over the past week, we've done this a few times now, and I actually notched this one Added it twice. So yeah, we'll save that guy. We're going to go back into the book again, back to that trade we were looking at, the short straddle. We're going to go out a week. We're going to invert it to get a long straddle. And then this would be the one we hedge against. So we're going to bring this guy in. And now we've got our calendar straddle position modeled. And at this point, this is pretty good. I mean, what this tells us is that in the event that it doesn't, if they can stay within that 13 to, plus or minus 13%, we should be turning a good profit this week for the trade. And again, this is a general helper, because the two things that we want to know here is, if this was a trade that we were looking at outside of an earnings period, this would be, I have a lot of faith in what this is telling us. However, because we're at a binary event like the earnings announcement, it is less it's less easy to predict what's going to happen, because we have a bunch of volatilities here that we know are going to move. They're going to move downward, and our proprietary crush data tells us that the downward movement that's going to come from these trades is actually going to be more likely on all the options, more than what's being modeled in right now. So the expectation right now is that it's using the volatility surface to kind of predict, or actually not to predict, to extract what the market is pricing this week's options to drop to. But at the same time, we know from experience that this week's options are really going to drop in line with the long-term mean of the implied volatility. So if we had this trade here, this could work out. I'm going to step back, though, into take a look at the options on the 1st, which is this Friday. And I'm going to do something a little different here. Is I'm going to come into this option chain, and I forget exactly what the range was we were looking at. If we go to manage the book again, we're looking at a plus or minus move of about 14%, which in the case of our current trade, we're looking to break even. It would be about about 350, and in this case 268.50. So 350 and 269 or 270. So we'll go back to the option chain, and this is for this week. So if we had 350, so we'll say we want to short a call here, and then we're going to customize our strategy to also add a short position for the 270 put. So the 270 put. So we're basically going to open up this short straddle, short strangle rather. Straddle is when you have the same strike. Strangle is separate strike, out of the money, and then there's the guts trade, which is different strikes in the money. So it's all semantics, but it just helps you visualize. I'm not going to model it in this book. I'm going to model it in my paper book, and this is so we can switch back and forth between those books. So I'm going to use the back button again, so I can move forward to the 8th, and then invert the position, or invert the strategy, and so I can model that in the paper book. And now what we have is we really have two different charts. So this is the straddle, if we go use that to strike about one volatility up or down, right? And then if I can change books, you see these are the accounts that I have, my brokerage account, my paper account. If I just switch, I can now switch back and forth between my Tesla books in either of those. And if you have multiple brokerage accounts, you can switch between those. Now, as we talked about yesterday, we didn't want to do a calendar straddle because when it talks about the mean return in a trade like this, a huge part of that is sort of tied up in this very little movement space. And the one thing that I think we can reasonably expect from Tesla and a lot of these high volatility stocks is that we should expect to see movement. It's unrealistic to not expect movement. So while this would be great if we hit the nail on the head, more likely it's this trade here. It's this paper trade that we've got. This would probably get us a much better return. Plus, we'd be more likely or more inclined to see a positive return as long as we didn't get a drastic move. Now, in the case of Tesla, a drastic move tomorrow would be more than a 20% drop and more than a 28% gain. And this is, priced around using what is fundamentally Black-Scholes option pricing. So it's not ideal for a binary event, but it is good enough for us to make kind of an educated guess on where we expect things to go and what the what the pricing and the risk is. So, and again, the other thing we worry about here is this drop in the middle. This is a substantial issue because if it does stay right in the middle, this could hurt us a bit. Part of the reason being that the return that we have here is probably overstated because what this is doing is it's taking the options for the current week and it's assuming that they result in a time value of 0. So it's using the intrinsic pricing at each of these terminal prices for this week's options. But the long value and the gain is coming largely from next week's options, which are being priced to a certain volatility with a week left as of end of day Friday at these terminal prices. So just to give you to kind of repeat that a little bit, let's say we take this 300 terminal price. Now at this point, the reason it's modeling a $270 portfolio impact as a gain is because it's saying that when we sell the position, or rather when we buy the position, we're selling a straddle, and the net result of that straddle is we will end up, in this case, not having to buy anything back because both those options will be far out of the money and we'll both let them expire. But the in the money options, but our next week options, which were long, they're both going to be out of the money too, but they will retain some time value. And the modeling here is saying that based on the time value that they should have, also based on the implied volatility that the volatility surface is showing that they should retain, that the net return on this trade would be $270.80. So if we closed it out at that moment of the market closing and we let them expire and so on. However, as part of the volatility crush, we are expecting the market to crush down next week's options as well, more than they're being modeled. So that's just, I mean, and when I say we are expecting, that's just the opinion that I have on the options, just because from historical, just from history, we know that the volatility should drop. Unless something comes out at earnings that's so substantial that it drives up the long-term volatility, the volatility we're going to see for Tesla tomorrow will most likely, these two options after earnings is cleared up, these two guys here, and this down here, all of these, instead of this being this huge drop, they're all going to be roughly in this range, in that high 50s, maybe low 60s. They might drop to mid 50s. It's tough to say where it'll be, but the point being that we should also understand that when we're doing these calendar trades around earnings, that this is going to be slightly overstated. So we shouldn't expect a return quite as good as this, but I'd be pretty happy with this trade. So I think we'll go ahead and we'll probably just place it. Now we can't send it here from the paper book into our main account, so unfortunately I'm going to have to do a little bit of gymnastics to make that happen. We'll move back over to this custom trade here. And it'll take a second to load it up. And I'm actually going to refresh the browser window. That'll clear out my pending books. This way I don't have to delete the other positions we were looking at. I'm going to move this into, I'm going to model this in the book here, and this is the long position that we have. So we've got that long trade in place now. And I'll just go back and kind of reverse the order we had, which is to invert the strategy and move it back to the current. And there we go. Model that, throw it at the book. And now what we're looking at is the calendar triangle, similar to what we opened up yesterday for AMD. We're going to open up one of those for Tesla today. And again, this here is overstated. It's pretty possible that this could end up returning, this could put us in a position where we break even. I don't think we'd do worse than break even. And then if we take a look at the overall value of the trade, it's at 476. I think what we'll do is we'll just double all our positions here. We could probably use a scale button in the UI. I'll make a note of that so we could scale our positions up or down. So we do that, track changes, which is now 2 of these. Nothing else should really change, and let's go see if we can place this trade. The net debit at 460. I think like yesterday, I'm going to put in an order here, see if I can't fill it, but we'll go fill it after hours. I'm sorry, after we end the stream here. I know that in order to get good pricing, sometimes we have to zero in on the legs, and I don't want to burn any more time here. We're also going to leave Exxon for another day. It is up. It is we are struggling with that. There's not much we can really do. I don't want to close it out where it's at right now. I think it's being driven up by the market. If we can get a flat day tomorrow or maybe a little drop, this could come down. So yeah, I'm going to leave that as is. Micron and Nvidia, we're just letting them ride. We're already accounted for full losses, so those are free trades. And yeah, I'm going to cut it off here. So if you have any questions or any feedback, of course, leave us a comment below or hit us up at hello@quantcha.com. And as always, good luck and good hunting.